So it appears from the market movements that globally markets are in uncharted territory and India is outperforming. How do you see the emerging market outlook?
Yes, markets are in uncharted territory. That's why the markets are highly volatile. And India, of course, is outperforming, while the S&P 500 in US is down by 24% from the peak. And the stocks 50 in Europe is down 24-25% from the peak. In India, the Nifty is now down only 7% from the peak. So there is clear outperformance. And uncertainty in the market, volatility in the market, and India's outperformance, all these are likely to continue in the medium term. So coming to the market outlook in the short to medium term, I will explain it with three scenarios. Nobody knows how the market, how the economy, the US economy particularly will behave in the next few months. In the last monetary policy announcement by the Fed chief Jerome Powell very categorically stated that nobody knows where the US economy will be 1 year from now. This is the Fed, and the Fed has an army of the world's top economists, and they say that nobody knows where the US economy will be 1 year from now because there are lots of uncertainties regarding the Ukraine war, regarding inflation, etc. Therefore, there are three scenarios. There are three probable scenarios, and one of that three scenarios will play out. I will explain these three scenarios. First, there is a base case scenario. This has the highest probability. The base case scenario is the US economy will go into a recession, but that recession will be short and mild. The market has already discounted this. That's why the market has corrected by around 24% from the peak. The market has already discounted this short and mild recession. If this scenario plays out, there will not be sharp up moves and sharp crashes in the market. The market is likely to consolidate at the current levels. Second scenario is a bullish scenario. Under this bullish scenario, the US economy will not slip into a recession. The Fed will succeed in what is called soft landing the economy, that is containing inflation without pushing the economy into a recession. So the recession may be avoided and inflation will start coming down because the US economy is even now strong. Unemployment is only 3.7%. Therefore, it is quite possible that the US may avoid a recession. The global economy may also avoid a sharp slowdown. That is a bullish scenario. If that scenario pans out, the markets will stage a big rally globally and more so in India. The third scenario is a bear case scenario. This also cannot be ruled out. In this bear case scenario, the US economy will slip into a recession, but that recession will not be mild and short. The recession will be sharp and long. So if the recession is sharp and it is long lasting, then it is quite possible that the markets may correct sharply from here because the markets have not discounted this. So these are the three scenarios, probable scenarios. The first scenario is the most likely scenario.
And there is a concern that market valuation is very high. And what is your take on this?
Well, it is true that valuations in India are high. In India, at 17,000 Nifty, the PE ratio, the forward PE ratio, 1 year forward PE ratio is about 20. Whereas in Morgan Stanley Emerging Market Index, the PE ratio is around 11.2, 11.3. So among emerging markets, India has the highest valuation. But this is a short-term concern. If you discount the 2024 earnings at 17,000 Nifty, the PE ratio is only 17. That is very fair. But if you discount the earnings for FY25, it can be very clearly argued that the market is cheap. So the conclusion here is short term the market is expensive. The medium term, the market is fairly valued. And from a 2-year perspective, the market is cheap. And this is my take on valuations.
So what should be the appropriate investment strategy in this time?
Well, the situation is uncertain. Therefore, the investment strategy has to be a little bit cautious. What should be the investment strategy will depend on the risk appetite of the investors. If the investor has only a low or a medium risk appetite, a cautious investment strategy is advisable. Let us say 50% in equity, 30% investment in fixed income, 10% in gold, and 10% in liquid funds or in cash. But if you have a higher risk appetite, you can increase the equity exposure to 60%, 70%. There are even people who are 100% invested in equities. It all depends on the risk appetite of investors. Now, a very important point that I would like to share with all the investors is that it is very important to remain invested in the market. All smart investors, all successful investors always remain invested in the market. The reason is you can never time the market. You cannot sell before a crash and buy before a rally. That is only in theory. In practice, it is almost impossible. It is important to remain invested. Why it is important to remain invested? Suppose there is a 20% rally in Nifty in 1 year. 90% of this rally will happen in 10 or 12 trading sessions. Right? So if you miss those very important trading sessions, you will be missing out on the bulk of the rally. Recently, we had a 1,000-point rally in sensex in 2 days. So a person who has sold and is waiting for a correction will miss out that. So it is very important that investors should remain invested. Also, investors should continue investing through the systematic investment plans in mutual funds. And in market declines, it is important to buy high-quality growth stocks. On declines, buy high-quality growth stocks and wait with a lot of patience. This is in brief the investment strategy which investors should follow in this very difficult and complex times.
Thank you very much.